We're not all here. There were 36, I noticed last I checked, who registered, but we will get going. Welcome to you all. And it's really a joy and a privilege to have the author of today's paper with us today, Joseph Huber. I doubt many, if any of you need an intro to him, but I will, in a brief moment, offer a couple highlights about him. But before that, I just want to kind of lay out the game plan for today, which starts with a very brief round of intros. So we all know who's in the room. And then Joseph has prepared a few introductory comments, maybe 15 or 20 minutes to lead us off. And then we will open the stack for questions and comments, either about his introductory comments or his article that we hopefully read for today, the case for central bank currency register. And for that discussion, maybe I should wait till later to say this, but let me say it now. We will try to stick to Joseph's comments and his paper. And if we go beyond that, then to the other papers that the Reading Circle has been reading. Some who are here today have read them and participated, maybe not all, but those are the Omarova's, the People's Ledger, and Hackett and Omarova's, the Finance Franchise, the Kumhof et al. Paper, and then the Fed's paper on central bank digital currency. And it's not the case that nothing else is relevant, it is. But those are the texts that we can trust, more or less, we share in common. And since this is a reading circle, we kind of want to not go off tangent too much. The other prefatory comment is that we try to share the air. So if you spoke already, try to give other people a chance to speak up. And if you care to hear someone in particular who hasn't raised their hand, feel free politely to welcome them in if you want. And I would add the last point. If it turns out that some of us here today didn't read Huber's paper, nor any of the others that the Reading Circle has read, you're very welcome to be here, but you might want to encourage yourself to listen rather than speaking up, since the conversation will focus around those topics and contents, and to use what you listen and learn to guide your reading of Huber's paper after. And then we'll use the last 10, 15 minutes to just, for those people who want to participate in sort of the last reading circle for this year of AFJM's life, we'll try to find a date for that. And that's the Meyer and Schnabel article on how to escape from the debt trap. So that's the game plan. And I think most people are here, a few more registered who aren't yet. But for the intros, what I want, really keeping it ever so briefly, but just so Joseph hears who we all are, and we all do, since we all don't know each other. Just 3 things, very brief: your name, your location, and very brief, just what was the main work you did for your living, or you're doing for your living, if you're not like all the old people in the room, retired. But so those 3 brief things, and just unmute yourself when you're ready to share, and I will call on people, and then mute yourself again when you've shared, and that way we'll hopefully be able to see that everyone has. So I'll just start briefly. My name is there, Lucille Eckrich. I am in Central Illinois in the US, a twin city, medium-sized twin city, Bloomington Normal. And I've made my living as an educator, adult educator, both in rural Africa, in inner city Chicago, and undergraduate and graduate education at the university level here in Central Illinois, a state public university. That was probably too long. So that's my intro. Adrian.
Hello, I'm Adrian Kuzminski. I live in upstate New York. I'm a retired philosophy professor and writer, and I'm quite interested in monetary theory and the politics of monetary theory. Leave it at that.
Great. I don't see anyone else unmuted. Please unmute. Like Rita.
Yes, I'm Rita Jacobs from Michigan, and I'm a retired probate lawyer and a member of the Green Party Banking and Monetary Reform Committee.
Thank you. Virginia.
Hi, I'm Virginia Hammond. I'm in Portland, Oregon. My career was as a head of a private school and community mediator facilitator.
Great. Bill Clancy.
Hi, my name is Bill Clancy. I live in Halifax, Nova Scotia, Canada. I was educated and trained as a lawyer. I switched out of private practice and became a manager, senior management at the Department of Justice in the courts division for approximately 20 years once I got out of private practice. So I'm now retired from both lawyering and managing.
Thank you. Welcome. Bruce Rogers Vaughn.
Bruce Rogers Vaughn in Franklin, Tennessee, near Nashville. I am a psychotherapist and recently retired after 23 years of teaching at Vanderbilt Divinity School.
Jeff Feather.
Hello, my name is Jeff Eder. I am one of the co-founders of Progressive Money Canada, and I am currently working on my golf game.
John Howell.
My name is John Howell. I'm in Athens, Ohio, and I'm a retired physiologist.
Richard.
Hi, I'm Rick Damari from the Boston area. I'm a lawyer, but this is my only interest in law. And my background is really wholesale seafood. This is my only interest in law. Yeah, shipping. And my background is really wholesale seafood. Somebody's echoing, but
Yeah.
My interest started in the 80s when I was trying to assert a property right and wages for the fishermen who I bought from. And it evolved into the money issue because it's my legal research led to that. You have to receive your wages in Treasury direct money in order to make the right possible to claim. So, but that's my interest. And,
Thank you. Thank you. Bruce Wall.
My name's Bruce Wall. I'm in Chicago, and I spent 27 years in the computer business, starting out without the slightest understanding of computers when they needed trainers, and wound up spending 27 years in that industry.
Great. Tabitha.
I am Tabitha Enriquez. I'm outside of Albuquerque, New Mexico, and I am one of the 2 co-managing directors for AFJM.
Margaret.
Yes, I am Margaret Blair. I am a economist by formal training, law professor by occupation and retired. And so, yeah, that's all I need to say.
Great. Steve Walsh.
Hello, Steve Walsh, Evanston, Illinois, a little north of Chicago. I'm educator, anthropologist, environmentalist with that background.
Whoops, you muted yourself, Stephen.
I helped push along AMI. I think that's where I left off.
Okay. So that's all I see unmuted. If you want to introduce yourself, please unmute Ed. Go ahead, Ed.
Hi, Ed Tuhig, Kent from Nova Scotia, American as well as Canadian, so I am interested in what happens in both countries. I'm a chartered accountant by profession. Ended up the years with consulting with an engineering firm in the international scene. Retired and wanted to tie in the economics, income tax, and money creation. And so just listening in, thank you.
Great. Georg.
My name is Georg Schmerzek. I'm currently in Uganda. I'm a PhD candidate in political philosophy at the University of Gothenburg in Sweden, and I'm giving a Rawlsian argument for sovereign money.
Great. Jacqueline.
Hi, my name is Jacqueline Haarsma. I'm in the Netherlands. I'm involved with Stichting Ons Geld in the Netherlands. My last job was an educator teaching economics at high school. And I'm still busy with this, although not employed.
Thank you. If you arrived after I gave the instructions, it's name, your location, and vary in a sentence just how you have or are making your living. Nisha.
Hi, hello, I'm Nisha. I'm from Durban in South Africa. I'm also from First Source Money in South Africa, and of course from the IMMR. I am, well, I am a justice activist for too many decades that I care to admit, a justice activist, starting from apartheid and all the way now to monetary and banking justice. But I actually professionally, I work on anti-white supremacy, anti-racism, and decolonial strategy, education, training, and filmmaking. Very happy to be here. Thank you, AJM, as always.
Thank you. Joe B.
Hi, my name is Joe Bongiovanni, and I'm down on the eastern shore of Virginia on Chesapeake Bay. And I'm a retired rural electric cooperative general manager.
Great, thanks. Mike Holden.
Hi, everybody. Mike Holden, River Falls, Wisconsin. I work in the Automotive Electrification Systems Lab at 3M as a developer.
Okay. Well, I think there are more people than have spoken, but that's all I see unmuted, and we have a sense of who's here. If you didn't introduce yourself, you are very welcome, and some are doing it in the chat. So thank you for that. You are very welcome, and some are doing it in the chat. Somehow I have it. Thank you for that. Somehow there's echo. I don't know. Hopefully it's gone. Okay. So just very brief intro to Joseph Huber. Just very brief intro to Joseph Huber. Do you all hear the echo?
Franz Verhagen needs to mute himself.
Do you all hear the echo?
Franz Verhagen needs to mute himself.
Okay, thank you, Franz. Hopefully that helps. So Professor Dr. Emeritus of Sociology of Economy and Ecology.
So my name
Professor
is
Dr. Emeritus of Sociology of Economy.
You're
Okay,
muted.
Franz wants to introduce himself. Please do, Franz. Okay, Franz wants to introduce himself.
Yeah,
Please do, Franz.
my name is Franz Verhagen. I'm a sustainability sociologist for international development with the focus and determination to transform the unjust, unsustainable, and therefore unstable international monetary system. I worked in Ghana, West Africa, and I worked in New York City for the last 40 years, and I'm now in North Carolina in Chapel Hill.
Great, thank you, Franz. And maybe do unmute.
Lucie, your audio is not working.
Thank you, Franz. Maybe. Hopefully it's working now. Can you hear me? Okay, thank you. So yes, Dr. Huber is a German citizen. He lives in Berlin. He was born and raised, I believe, in Mannheim, which is about an hour from Frankfurt, south of Frankfurt, Germany, and also across the Rhine River Valley from where my spouse, Franz, grew up. And he and my spouse and my broken German speak the same dialect. So we have that in common. Many of us here, I think, have met him many times in Chicago or the last 2 years on Zoom at the American Monetary Institute conference, at which Joseph was a regular speaker. And he, I believe, retired in about 2016. And prior to that, and since then, has really been working tirelessly on monetary reform, sovereign money reform, including heavily involved, I believe, with the Full Geld initiative in Switzerland, which had a referendum in 2018. And he's a founding member of the German monetary reform group, Monetiva, and a founding member of IMMR. He's the author of the book, Incisive, and very well informed book and website called Sovereign Money. A lot more on the website even than in his book. And on a personal note, I want to say that we, my spouse, my then college-age son, met for dinner and breakfast the next day with Joseph in January of 2018 in Berlin, a few other members of Monetiva then. And that was, in thinking about this today, the last time I saw Joseph in person, the organizing committee for the Alliance for Just Money had just gotten established and had its first meeting. And so a lot of ground has been covered for us as monetary reformers, at least in the US since then, and I think internationally with IMMR. And finally, Joseph is on AFJM's advisory board, and that and his being with us today are really gifts for us. And in fact, it was a result of our CCing Joseph as an advisory board member and our other members on our announcements for these reading circles, sort of to keep them in the loop, that Joseph reached out to share that the question of how to account for central bank money and sovereign money is not new in these more recent articles we've been reading, but something that he and others addressed both in writing and presenting during the lead up to the 2018 Swiss Full Geld referendum, if not before that. And he said in the email, unfortunately, we had the impression that at the time, nobody was really interested in these boring accounting matters. And he's glad that we're interested in the topic. And so without any further ado, I can say, I'm sorry it took me and maybe us so long, Joseph. I think maybe we were busy starting AFJM at the time, but we are finally and seriously interested in the contents of your paper. And we really thank you on behalf of all of us here in AFJM for being with us, for all the years of work that are behind what you will talk with us about, and for the greater clarity that I think we will all walk away with today. So thank you, and I'm going to mute myself, and the floor is yours till you're done. So thank you.
Okay. Finally, Lucille, thank you so much for the welcome, and hello to everybody present here. I am quite impressed by the group of people who have come together here, and yeah, I'm glad to have been invited to do that talk. And now in medias res, now for a start, I wanted to show you a slide. One moment, please. The host has deactivated. I want to show you a slide. Here it is. Here we go. Where is it? Here we are. So that's proceeding very slowly. The Atlantic is in between. Okay. What I wanted to say with this slide is that that's the way about 20 years ago, at the beginning of the current monetary reform movement, that's the way we thought about, we imagined how the creation of central bank money or sovereign money respectively, that would be done. And so it means that we started from the conventional practice of creating money as a pairwise balance sheet entry of asset and liability. And the asset would be a credit claim on a bank or the government, and the liability would represent the book money in those actors' central bank accounts. And the difference to conventional practice was that we thought of that credit not to be interest bearing and being extended without maturity. So in a sense, a sort of eternal credit, so to say. And I soon learned that in Anglo-Saxon finance, such a beast is called a zero coupon perpetual consor, which in fact is something contradicting itself, in that according to form, it is debt, but according to pragmatic agreement, so to say, it's considered not to be debt. And basically, as we had to concede later on, that's in a way inconsistent. It's a distortion of the notions of credit and debt. So let me make a break here for a moment. We then had to rethink our initial unsatisfactory approach to central bank money creation in the time between 2011 up to 18, in the run-up to the Swiss referendum on sovereign money reform, and similar campaigns, for example, in the Netherlands, and also a parliamentary initiative in Iceland at the time. And during all that time, or most of that time, we still insisted, erroneously, as I would say today, that central bank money created as such a zero coupon perpetual that would be debt free. And well, this became a bone of contention. And for example, there was a situation, there was an interview on Icelandic TV in 2015, and a Dutch postkensen by the name of Dirk Bessemer, he said, debt-free money cannot exist because modern money is credit and debt. And so debt-free money is impossible like dry water, he said. By contrast, we in the monetary reform movement, we thought, as I remain convinced of, that the alleged identity of money and credit is a false identity. It's an arbitrary doctrine because, as a matter of fact, the creditor-debtor relationship on the one hand and the means of payment on the other hand, these are two different things. I have a quote here, which reads as follows: money need not be something owed and due. Money is what we used to pay something owed and due. And that is taken from a paper by Stephen Walsh, co-authored by Stephen Zarlanga and written 10 years ago. Some of you may know that. And in this understanding, money is not credit, but money is the means to disperse credit. And in the same sense, likewise, money is not debt, but money is the means to redeem debt. And this is stated, by the way, on US dollars, on US dollar bills since the 1860s, where it reads, this note is legal tender for all debt, public and private. Very simply and down to the point. And so money, in that sense, is an asset of positive existence. And as such, it ought to be accounted for as a monetary asset of positive existence not as a liability of the issuer. And then the crucial question here is, how is central bank money circulated as a pure monetary asset in the first place? And what soon emerged in this regard is what we can call the equity approach to sovereign money or central bank money. And here I want to show you a next slide, that one here. I hope you can see that.
Yes, we can.
Okay. And now that approach intends to account for newly created central bank money as equity. No, that's the wrong one. Wait, oh, here we are. And that idea was put forth in quite a number of publications since about 2014, up to the 2020 paper by Kumhoff, Omarova, and co-authors, which you have discussed here recently, as far as I know. And they concluded to consider central bank money as a kind of social equity or equity of the nation. And I very much agree with that, at least in a general sense of a nation's monetary endowment. However, I have to say that most supporters of that equity approach, they did not explain how they would do the accounting. And in terms of accountancy, I am afraid that the equity approach is not entirely convincing yet. And why? For those who made that proposal, who made a proposal on how to account for their money, this boils down to insert a new category of profit, in the profit and loss statement. You can call it national equity or genuine seigniorage or base money creation. Howsoever, in my opinion, this is just another distortion. And in this case, it's a distortion of the well-established notions of equity, as well as of the notions of profit and loss. Newly created central bank money is not part of a central bank's liable equity. So I think I should repeat that. Newly created central bank money is not part of a central bank's liable equity. And likewise, the gain from money creation, the seigniorage, does not result as the difference of earnings and expenses in the profit and loss statement. So that's not stable here. Where am I? Here. So if you see right side down, so the profit and loss statement, what adds to the equity is the difference, earnings minus expenses. But the act of sovereign money creation, that's not a business act of generating earnings and in connection with expenses done before and so on. So these are two different things. If we regard interest-borne central bank profit, this is indeed a result from the profit and loss statement, but this does not apply to newly created central bank money as genuine debt-free seigniorage. Now, I stop that here. Okay. In the course of dealing with that question of how to account for sovereign money or central bank money in an appropriate way and in line with the law and in line with the accounting standards, I came back to a very early classical approach, and that is Ricardo's plan for the establishment of a national bank from 200 years ago. And according to this concept, that concept has been implemented, by the way, by the Bank of England. And according to that plan, the Bank of England was subdivided into an issue department responsible for the issuance of central bank notes, and another, the banking department, which conducts the commercial operational central bank business. And what did that mean? That meant, and the intention of it was and is, to separate money from credit, separating the money creation from credit and debt banking. And this is the exact opposite of what was going to prevail later on, since towards the end of the 19th century, what we have today as so-called credit money and debt money. The separation of the note issuance department and the banking operations department, that still exists at the Bank of England today, up to the present day. However, that matter soon proved to be of little relevance, because the separation of money and credit at the time was not consistently implemented. For example, so-called country banks, they were able to continue issuing private banknotes for a very long time. And most importantly, the development of cashless payment and the development of bank money was not taken into account, while in actual fact and over time, bank money developed into the dominant type of money today, marginalizing central bank money, marginalizing cash and reserves. So the implementation of that plan went wrong at the time, but I think this does not prove the unsuitability of that plan. In my opinion, the intention to separate sovereign money creation from credit and debt banking, that remains fully valid, and today more valid than ever before. Now I want to show you in the next slide. Come on. Here, it's that one now. Oh,
Yes, we see the account structure of the currency register. We see.
So, okay, let's continue. My approach now is what you see here. Instead of having separate organizational entities, the idea is to introduce a separate ledger apart from the central bank balance sheet. So you have two books, that separate ledger, and the commercial central bank balance sheet. And that's a journal by means of which money creation takes place. That ledger is not a balance sheet. It's not about double entry bookkeeping. Rather, it's, as I call it here, it's a register, a currency registry. And the entries of newly created central bank money made therein are to be seen as sovereign acts of sovereign money creation. And these acts do not link to preceding business operations, as is required by current accountancy, by current accounting standards. My insight is that double entry bookkeeping cannot be meaningfully used to represent modern money creation. That's why we have to invent something to make these two things compatible: debt-free sovereign money creation on the one hand, and the commercial business banking, including central bank business banking on the other hand. So this is an accounting journal, and it records the creation of central bank money put into circulation, the current stock, as well as the channels of issuance. So we have two types of account here, a currency account and an issue account. And the currency account, it shows the quantities of money in its different forms, coins and notes, today's reserves, that is money on account, book money on account, and the future central bank digital currency. In a not too distant future, we will have that across the world within the next 5 to 10 years. And the issue account, furthermore, that shows the same quantities of central bank money according to the channel of issuance. And one of the channels of issuance is depositing such central bank money on the central bank balance sheet. And such as today, cash in vault, one has cash in vault, and in future then also stocks of reserves and central bank digital currency in stock, so to say. So the other channel ought to be debt-free genuine seigniorage to the benefit of the public purse, which is something that cannot be done from a commercial balance sheet, because from a commercial balance sheet, if that would be done, the respective central bank or other organization would soon run into negative equity. So that's the point. In my opinion, the deposits of the currency register in the central bank's balance sheet are non-interest bearing credits at further notice, so that can be handled flexibly, that can flexibly be readjusted, the amount of money. And interest is out of place here anyway, because this is about two ledgers of one and the same central bank, so it does not make sense to have interest between these two ledgers. Right, the next slide now, the last slide, this one. Proceeding by means of such a currency register, that makes sure from the outset that central bank money enters the central bank balance sheet as a monetary asset, having a positive existence of its own, and not as a circulating liability and not as a circulating promise to pay, but as money that can actually and fully be dispersed, that can actually fully be paid out directly, be transferred from payer to payee or from a creditor to debtor or howsoever.
Joseph,
Yes.
Did you intend to advance the slide?
Sorry?
Did you intend
what?
to advance the
Yes.
slide?
Don't you see that?
We see still the account structure of the currency register.
Oh, no. My dear. What do you see now?
Click there.
Yeah, we're good now, Joseph.
Yes, now we have it.
Oh, I did see that one all the time. I didn't realize you don't see it because I saw it on my screen.
We now see it. We now see it.
Yeah, I'm sorry.
Okay.
So this slide intends to show that the amount of money created and spent or lent or whatever directly. So it's really dispersed from the central bank to a bank or to the government, and so. And it's dispersed, it's paid out. That shall be shown here now. And so the money circulating there, that's an asset from the beginning. It's not a liability neither, nor is it a promise to pay. It's something that is paid out. Yeah. So yes. And the thing is, in terms of accounting, when that money is lent or invested, this results in a clear asset swap, a swap of assets. And that amount of money is swapped for a credit claim, and the the creation of the amount of money is not disguised, so to say, by entering a credit claim on money that has to be repaid. And so it's a swap of asset, and that cannot be, it's not a confusing credit and debt entry as we have it today, where the money is confounded with a credit claim on money, and the liability to pay out amount of money is mistaken for the final disbursement of that amount of money and used as if it were the money to be disbursed. That's the confusing situation today. But if the money starts to be a monetary asset from the beginning, such confusion need not happen. And that confusion only happens because it's, as far as I can see, the only way to show it within the double entry bookkeeping, but it's not consistent. It actually, in different ways, it's not consistent with international accounting rules, and it's not consistent with credit laws either. But well, that would lead too far for a start. Yeah, and a last word. As far as the liability on the central bank balance sheet is concerned, this is not a liability to banks or to customers, it's a liability to the currency register. And if the central bank decided to cancel some of that credit, the money is repaid to the credit register, by which act the money is deleted. And that's it. And yeah, that's what I wanted to do for input. Thanks.
Mm-hmm. Thank you very much. Can I stop sharing your screen? Is that?
Yes.
Great.
I did so.
Yeah, thank you. I trust people in the room to greater and lesser degrees understood those contents. I know I'm somewhere in the middle, I'm sure, but I do see Joe has one hand up. So just a word of instruction before I turn to Joe Bongiovanni is that you should have on your screen at the bottom a reactions option, either directly or if you click on the three dots that say more, you'll see reactions there. And if you click on that, at the bottom of what comes up, there's a raise hand option. And that is how the best way to get in the queue for this discussion. So let's try to use that, and I will call on people in the order that they have their hands raised. So Joe, please unmute yourself and then go ahead.
Okay, I'm assuming that I'm being heard. And I want to thank Dr. Huber for so much for the presentation, but mostly really for the work that he's done over the many years in trying to advance sovereign money as we know it. And however, I have to put my however right there and say that Dr. Huber should know, based on Dr. Hyman Minsky's guidance towards to creating discussing economic theory, that anybody should make where they are coming from known at the outset, and so I want to make it known at the outset that I'm opposed to any notion of central bank digital currency being related to sovereign money in any way. Okay, now I don't know how economists learn about the monetary economy. I know how I learned about it, and based on what I've learned about it, I'm going to make a couple of observations here for what Dr. Huber has presented. The first is to find a really deeply perplexing question of why sovereign money is equated with central bank money. Mm-hmm. You know, like in the same notion, the same thought and idea, sovereign money and central bank money, they're the same thing. Sorry, sovereign money, I thought you and I agreed what sovereign money was. You know, it's created by the issuing authority, issued and gained into into the account of the government. And when I look at this accounting stuff, that's not what I see. You know, I see, looks to me like government creating money, in theory, by the way, the central bank, I mean, and that's another thing, the central bank. We know we have a private central bank. There's lots of private central banks, but even the ones that are in theory public central banks today, almost exclusively in the central banking regime that rules the world, is the private banks that issue the money. So that the fact of having a central bank owned, you know, does not change the issue of the sacredness of the seigniorage power of the monetary system. So to me, it's like there's too many balls in the air right here. And to me, what we really should have are two accounts. One of them is for sovereign money, period. You know, I don't understand why there's a joining of sovereign money with central bank money. I mean, central bank money, I even have to ask this question at the outset, because I have studied the central banking system in this country. And I have to be honest and say that for my definition of money, and I don't know about the people who share it, I kind of share the one that Stephen Walsh put out there, you know, but to me, if it's not circulating, if it's not a media that's circulating in the economy, and it's not something that imparts purchasing power to the person who's holding it, it's not money. Okay, that's just as simple as it is. It's not money, it's other things, it's some other form of media. So my question then is, why do we join, why at the outset of this exercise, you know, are we joining sovereign money with central bank money? And the issuing seems to be going all over the place with central bank money, when with sovereign money, all of it is going to be public money, publicly spent. Like that.
Yeah.
My apologies.
Yeah. Let me ask, is someone else here who would like to say something in the same vein, relating to that issue Joe has come up with here? No? Then let me repeat. I tend to think I fully understand what you mean, and there is we have to see that the United States and European countries, as well as other countries towards the east, have a different history with central banks. Because since the Bank of England Act in 1833, and since the middle of the 19th century, most central banks in Europe have been more or less nationalized. They are state agencies, state bodies, state authorities. So in a sense, they are monetary authorities, or they should be. And in the United States, by contrast, you had, as you know, you had two attempts to create a central bank, a private central bank in the early 19th century, and then for financing the Civil War. You created the greenbacks to pay for, as before the colonial bills were created in the 18th century by the colonial governors, and the continental dollar was created to pay for the War of Independence. And so you have a history of state money, of state-issued, government-issued money. And there is a parallel history in Europe, but that very often went every, you know? I mean, so in Europe, we have a history of overdone private bank money creation, banknote creation, but also of overdone government bills creation, and so. And that's why, so that's a considerable difference. And our concept in our monetary reform initiative, at least in the German-speaking countries, we think of a separation, a continued separation of powers within the state. We have the separation of, we have the government and the parliament, and we have an independent judiciary. And in the same sense, we think of having an independent monetary authority. We call that the monetary power, monetative, the monetary power, complementing the judiciary and the legislative power and so on. And there should be some sort of division of functions, division of labor, but also cooperation, of course. Today, this is a bit illusionary. I agree with you when you are critical about the role of central banks today, because of fractional reserve banking, central banks are so intertwined with the banking sector. So I think central banks do not exert control. The monetary control today and the initiative is with the banking sector. And the role of central banks actually is they are sort of kind of auxiliary body that reacts to the facts the banking sector has created beforehand. But that's the situation we actually would see to change now. And as far as I know, in the United States too, today, the top personnel of the Federal Reserve, as well as the Open Market Committee, which is the decisive committee for doing monetary policy, that's no longer a simple banking affair. That's under state law, so to say, to my knowledge, under public law. And the US Treasury has a lot to say in that, or it has to say in that. And it is the major actor in these institutions, if I'm not wrong. And so so there is you see in Europe, you will not, since the end of Second World War and the interwar period, you will not find many experts that would agree with the government or the Treasury Finance Ministries creating the money they spent themselves. And that's a very specific American thing. And it has so often been abused of, it has so often been misused that, yeah, it's an important historical difference between the United States and Europe and the rest of the world. Will you see what I mean?
Do you want to comment, Joe, and then we move
No,
on?
am I still open? I thought I muted myself, but maybe I didn't. No, I would much rather give other people an opportunity to speak and to get back with it if we might. Thank you.
Okay, thanks, Joe. Margaret, can you unmute yourself and I can spotlight you.
Oops.
There you go.
Hello, I just had eye surgery 2 days ago and its sun just came out. So I need to put on the big sunglasses here. So I think it's two separate questions. The first one is, I've had trouble understanding what hinges on the accounting treatment, because why does it matter what the accounting treatment is? And maybe it does just for rhetorical purposes when we're talking about whether the government should raise money whether the government should pay for its programs by issuing bonds or whether it should pay for its programs by just creating money. So maybe that's all that there is, but if not, what else hinges on this question of the accounting treatment? So why are we giving it? Why are you so interested in it? What got you so interested in it? And the second question is, if we treated right now, the way the money gets created is that the government in effect spins it into existence because it is created when it is loaned to banks for them to in turn to be able to use it to loan out for productive activity. And in that manner, it comes into existence in response to the need of people in the economy for liquid assets in order to be able to put together a business, buy resources, whatever it is. And if it were just created and kept in a separate account, would its purpose still be to loan out to banks? How would it be circulated? And how would it be? It doesn't do any good if it's just sitting on the books of the central bank and it's not being utilized. It's only providing stimulus to the economic development if it's being circulated. So if you're going to circulate it, who would get it? What would be your channel through which it would be circulated?
I might clarify.
Well, these are, sorry?
No, go ahead, Joseph. Go ahead.
Okay. Well, these are two quite complex questions. But let me try to say something that makes sense about that. Well, you see, basically, you could say from a very pragmatic point of view, you could say, well, we continue to do the accounting as we have done so, as we are doing until today. We create credit and debt money, and we put it by that pairwise entry. We make a credit claim on the asset side and so on. You can say so, yeah. Why not? Or you can make some sort of reform to introduce that equity approach, and formally that's possible. But I would say my reason is for trying to find a different solution is that the two aforementioned constructions, they are a bit murky, they are inconsistent in themselves, and you have that problem of creating too much debt, for example, we should be able to make a difference between when you start with the credit and debt approach. We should at least be able to make a difference between a distinction between monetary credit that creates money and intermediary credit that simply circulates already existing money. But in the present system, we are not able to do that. And there are inconsistencies in the sense of, for example, the credit laws, at least the ones I know from Europe. The credit laws demand that a credit be dispersed from the creditor's assets, paid out, adding to the debtor's assets. But the practice, such as it exists today, that money is not dispersed. No, there is you get something on an account, which is it's not the money, it's a claim. You have a claim on the bank or whomsoever to have paid out money, but what you get is simply, it's an entry on account, and we use it as money. We can continue to do that, but it's murky. It's a murky construction. And in the same way, you see the general agreed accounting principles and the international financial reporting standards. So they demand, for example, that any bookkeeping process, any bookkeeping entry to be related to a preceding business activity, to a preceding business process. But when a central bank or a bank today creates new money on account, So that's not, there is no preceding Business Act. It's in actual fact, it's a murky construction taken out of nothing, so to say. And that sovereign right to create money out of nothing, modern fiat money, that should not be left to whom. So it should not be left to private commercial interest. It should be the prerogative of a monetary authority, and that is accountable and responsible and so on. That's another reason why we came to reflect all these things and trying to find a solution that would be consistent in itself and also doing justice to the law, to the credit laws, dispersing the amount of money rather than pretending to disperse it without doing so, which is what we are doing today. And that's behind our endeavors to. And I mean, I think it's not by chance that over the last years, also within the central banks, the research staff, the experts have started to think about alternative ways of doing the money creation, particularly when we are going to have digital currency, which is very likely not to be money on account as the money hitherto, the cashless payment tokens, but that will be digital currency, which is held in e-wallets and being transferred directly from payer to payee. And so I think we need to have a more clear, a more transparent and more consistent way of creating and issuing money. Yeah, that's what I can say right now, spontaneously, so to say.
Thank you, Joseph. I don't know if I misheard you, Margaret, or I heard you say what I think is not, is what I'm going to say. And that is, when you asked your second question, it seemed to me your first description of what I think you meant to say was describing the system as it is, was not, because you said the government lends the people, and in fact, or the businesses for productivity. And that's not what happens. It's the private commercial banks that do the lending and the creating in the process of that lending. And so the layout that you described was closer to what we would like to be the case with sovereign money rather than what is the case. And definitely your second description of, there would be no reason. The money is about a transaction lubricant, that's what it exists to do. It's not money if it's sitting in an account, not being money. So the second scenario would not be what a sovereign money system is. So I don't know if that helped, but it may help you to understand Joseph's answer, like to think about, and maybe I misread you, and I'm going to be quiet because we have other people with their hands up, but if you want to comment anything before we move on. Oops, you just muted yourself. You muted.
Yeah, so the way money is created now, first of all, it's important to understand that there's not a fine line between money and near money. There's all kinds of different ways, and that money, the creation of money by banks is used in response to the need of a business person or whatever, a borrower, who wants money, so they get a loan, and it's in the process of making the loan that the bank money gets created, and so it's responding to a specific need in the economy for a transaction, and the Federal Reserve creates money in a sense the same way, which is it responds to the need of the bank for more liquidity. So it loans them money by just saying, okay, you have money, and but from the point of view of the bank, it's a loan. They have to pay it back, and because they have to pay it back, they should only be using it in a productive way so that there will be resources to repay the loan. And so so I have a difficulty understanding, you know, somebody posted, and I don't know who it was, and I haven't followed the chat commentary because I was trying to stay focused on this one, but that, well, it should only be used to pay wages. Well, if the government just pays wages, who is it that demands that the work be done, that the person caused the person to earn the money? So what I'm thinking is that the government, if the business employs a person and pays them, they have to come up with the money to pay that person, which means they have to only employ the person if the person is doing something productive that they are willing to pay for. And that the current process relies on the private sector to come forward with a demand for transaction, for currency or money or whatever form you want it to take, in order to lubricate a transaction. And it's a specific transaction where the parties on both sides have an incentive to make sure there's value being created there. And if there's not, then one of the parties won't enter into the transaction, and there won't be money created, or there won't be money needed. And the other stuff I hear going on, I guess I just don't understand.
Yeah, well, well, you see, I think it's not entirely the way you put it here, because banks, commercial banks, including shadow banks today, and including investment banking on the basis of bank money creation by commercial banks, in recent decades, the lion's share of newly created money did not go into productive uses.
Yes.
It did not go into the real, so-called real economy, but it went into non-GDP finance. Non-GDP finance, I don't understand what you say.
You don't fix that by changing the accounting treatment at the level of the
Oh, sure we can fix that to a considerable extent, because today the money it either goes into non-GDP finance that does not immediately or not at all contribute to financing GDP. And at the same time, the government has to intervene compensatorily, and the government has to go into debt instead of being able to get a fair share of new money to be created, debt-free, public money, so to say. The government today has to go into debt, ever deeper into debt. And of course, we have methods. We can roll over the debt, so we can practice that. In actual fact, that concept of zero coupon perpetual console, even with some interest, it doesn't matter because the money can freely be created today. But that's inconsistent. It creates a huge confusion. And that's why you see in a system where sovereign money could be created in a way, in that or a similar way as I have described, much of that money would be issued debt-free. And if the government spends money, you can be sure that the most part of it, at least in the first instance, goes into real economic activities. Where it is ending up later on, that's a different question. I agree with that. And by the way, I'm not arguing against non-GDP finance, because that's important too. Having non-GDP finance, because that's creating savings, that's creating own capital, and so on. It's creating private research, which is necessary to have. The problem is too much non-GDP finance, and that's what private banking is doing today. That's one point, and I remembered one point, please, going back to Joe. I hope Joe is still listening. I remember once we had a discussion once about 100% money and Irving Fisher. It's a couple of years ago, and as far as I remember, that was the connection, so to say, how you came to monetary reform via your father's engagement for 100% money. And I remember that Irving Fisher, he wanted to have issued that money by an independent currency board. That would not be the treasurer. That would have been an independent currency board. And that's very similar to what our idea of it is.
Mm-hmm. Thank you. Thanks, Margaret, for the good question. Following up on Joe's good question, I think we should move on to Virginia. There are at least 5 others in the stack. So thank you, Margaret. Virginia?
Well, I love the idea of a registry about how much money there is. That would really simplify research in trying to figure out what the money supply is. My question is, the US books the seigniorage of coin as income. It just books it as seigniorage income. So isn't the simplest approach to create new money by an act of Congress and then enter this money as income and cash, which is just ordinary double entry bookkeeping into the government's bank account? The central bank remains as the banker to the banks and as the government's bank. But why does it need to play any role in the creation of this new money, except as the keeper of the US government's accounts? Certainly, and then in terms of the digital currency, the law that institutes the just money system could require that some percentage of the new money created goes directly to citizens. And that would be in an optional, some kind of, cryptocurrency system, but it would really just simply be an alternative to paper cash. You can use your money as paper cash, you can use your money as a digital currency, or you use it as just the standard way we use all the money we use today. So my question again is, why does the central bank need to play a role at all, except as keeper of the government's account?
Yeah. Well, first let me ask, in the United States, isn't coin sold to the Federal Reserve?
No, that is what
No.
Cash bills are created by the government mint, and then they are sold at the cost of production to the central bank, who then creates them as money in exchanging them with other currencies. But coins are produced by the mint, and on the mint's balance sheet, or in the mint's individual accounts, which are part of the government's accounts, it books the cost of production of the coins, and then it books the seigniorage. Well, what is the difference in the value? And that just becomes part of the government's income. It's booked as an income. So
that's what Joseph implied.
Yeah, that's all right. But how then are the coins circulated?
The government.
In which way? How do those coins enter into general circulation?
You have to buy them from the government.
No. The Fed passes them on to the banks as banks require cash and coin. or currency and coin, I should say, as they request notes and coins, the Fed gets the seigniorage over the notes, and the Fed has already paid the seigniorage to the Treasury. And that's how the accounting works presently.
Well, but the coins are accounted for differently than the bills.
Yes, I said that.
At their face value, the coins enter the government's account at their face value. The paper bills, but then through the banking system is how they get into people's pockets and slot machines and whatever. But the paper bills, the Fed simply pays the cost of producing them, and they enter circulation through the banks, and the banks get all the seigniorage.
Well,
all
the
of it.
the central bank gets it.
The central banks. And do the banks themselves?
No, the central banks have to exchange existing money for cash, bills, and then that is how it enters the system. Coins have to be exchanged with the US government or the mint actually, for existing money. So basically you're pulling money, you're creating
Existing bank money, right?
Yeah, except the government never had that. That's an interesting point. Okay.
Well, Stephen, do you want to say something?
The Fed only, for $100 bill, the Fed pays 12.5 cents. When the Fed turns that $100 bill or $100 note over to the bank, the bank pays $100. It pays the face value. For the quarter, it costs 5 cents to make a quarter. The Fed will pay the Treasury, or will credit the Treasury's account at the Fed 25 cents. So they're getting full face value from the accounting perspective at that point in time. And then the Fed gets the seigniorage as income. And then, as we all know, it declares excess money at the end of the year, and it gives that over. You can call it profits or extra profits that go back to the government. So the government can recapture some little bit of seigniorage from that. But that's small peanuts. So anyhow, I'll be quiet there.
So just to clarify though, so you're saying that when that coins all have to go through the central bank, which is creating the money to buy them at full face value. But you know, the Treasury sells coins directly to the public.
That's fine too. And then they deposit it in their account at commercial banks again, or at the Fed, and they get full face value. So in either case, the accounting balances out and they get full face value or get the full seigniorage, that 20-cent difference in either case.
But then are you saying effectively the government today is not even creating money with coins, which is kind of what we've been saying, that it is, again, the bank of the bankers in the US, the private central bank, that is converting some of the coins, and then the rest of the coins are being traded for money in the existing system. So today our government creates absolutely no money. Is that what you're saying?
I think we're also talking about peanuts, because the bulk of the money supply is bank money, is check money in an account. So, but I do think there is a meaningful difference, and coins, because the seigniorage for coins goes to the government. The government
I raised it as an issue, not because of the percentage, but as a way of accounting. Why can't Congress just say, here's this much new money, you know, book it as income? And it doesn't need to come from anywhere. It doesn't need to come from the new system. You just put it in there. There's this much more money.
Yes, but it's the way how you put it in, that's one needs to be quite careful, I think. Basically, I can follow your idea, because what you propose, you say Congress should do, but then the question arises: how does Congress know about monetary economics and money markets and so on and so on?
Well,
I would say
the idea was
it could be. Now, it's not the important question, or not the most important question. You can do it that way, but I think, realistically speaking, under current conditions, that will not go through. So what we have and what will continue to exist is we have banks, and we have some public or state monetary bodies or authorities, such as state-run central banks or similarly. And the idea that the parliament or the treasury itself are going to create that money, that will not go through. So that's one point, I think. And for the rest, I would say your idea and having a currency register or registry or having a currency board, that's very similar, because your idea and the currency board in Irving Fisher and the currency registry we are proposing would fulfill the same function. And
well,
so far, I can follow what you...
money. That is part of our. That is part of the just money concept. Is that there is a steady money agency, whether you want to call it an authority or whatever, who could keep that registry, and they would be the idea of deciding how much new money can be created. It is to some extent a technocratic job. You really do need experts to do that, and we currently don't even have anybody making any kind of decision about how much money to enter. It's that decision making is very broadly distributed, and we too could broadly distribute it, but Congress is not deciding how much in the just money plan. It's deciding, it is simply an act of Congress that says, here's new money, and it goes into the account.
Yes, but you see, I mean, you would have to generalize the mechanism you have described. You would have to generalize it, including money on account, today's money on account, as well as future digital tokens. And then the situation would be, I think, slightly more complex. And today, by the way, the first initiative for creating money, that is with the banking sector, while government institutions or central banks and so on, they react and accommodate the facts the banking sector has created beforehand, so that that mechanism of creating, as long as the banking sector has the power and fulfills the function of creating money on account or digital tokens in the first place, so the situation will not change. Yeah, and I think there needs to be a close feedback between money markets and money creation. So not in a sense of always accommodating what the markets demand, not that, but also that, including that, a close. How would that be done? So in our concept, that currency registry and central banking are it's just two different ledgers of one body that should be the government, the monetary government, so to say, and that is closely related to, and there is a close feedback to the money markets. And I do not see how that would function if a separate body like the US Treasury or the Congress would decide on money creation. I can't see that. Basically, I think, as far as I understand your idea, sure, it could be done, but I'm not sure whether it would really work. I don't know. I mean, I have to say, in 300 years ago or 250 years ago, the then governors of the American colonies, they apparently they had a hand for finding sort of balance between too much money and not enough money. But the situation today is much more, the volumes are incredibly bigger and much more differentiated. And I don't know whether, yeah, I think these things should be under control of a body that is intrinsically part of the money market.
Maybe we should move on to the next question. I do think what Virginia was suggesting is in sync with the NEED Act and with, you know, therefore then our update of the NEED Act. It's and definitely it was an independent monetary authority that would be determining how much money is needed to be newly created, the purposes for which would be decided by Congress, but not the amounts. But maybe we should move on to Bill's question. There are 4 others on the stack. Go ahead, Bill, welcome.
Thank you, Lucille. Professor, thank you for coming today. I think you mentioned a little earlier in your presentation that you foresee central bank digital currency not being in place for 5 to 10 years. And I'm wondering if you consider the sovereign money creation through the currency register to have the same kind of a time frame as the CBDC, 5 to 10 years. And if that's the case, in the interim, because governments, you know, desperately need financing for the programs that need to be done, are you vehemently opposed, or do you have any great opposition to governments, treasuries, and central banks continuing? I think you used to call it paso doble, acting in paso doble, where they're buying, where the central banks are buying up the treasury bonds, and which is enshrined actually in the Bank of Canada Act, because Section 18C of the Bank of Canada Act, you know, legislatively authorizes that paso doble to take place. So I'm just wondering if that's the time frame for we're looking at for sovereign money to come, either by way of the currency register or by way of central bank digital currency, if that's a path towards sovereign money. If it's a 5 to 10 year time frame, we really need help in the meantime. We need help today. And when you look at the pandemic in Canada, the federal government purchased 300 billion government bonds. I'm sorry, the Bank of Canada purchased 300 billion federal government bonds and about 60 billion of provincial government bonds to help us get through the pandemic. So I know it's not your, I know you consider it a paso doble and it's not your favorite way of creating money for government financing, but would you be greatly opposed to continuing the use of those bond sales, which, and we're checking on this with Progressive Money, with Jeff Eder, but we're checking on those bonds, and but they're not perpetual console type of arrangements. They are bonds with maturity dates, a term with so much maturity dates and interest. And there's talk, of course, the Bank of Canada wants to get those bonds off their balance sheets and switch partners in the Paso Doble back to the private commercial financial institutions. So just wondering if you're given the timeframes, are you opposed to that Paso Doble continuing?
Yeah. No, I'm not opposed. And as for the time frame, the timeline, I don't have a timeline for that. I'm sorry, I can't make some sort of forecast. It's impossible, mission impossible. And I am not opposed to doing, for pragmatic reasons, for doing that Paso Doble. And I think we should briefly explain what it means so that all participants here follow what you mean. The Paso Doble it's a two-step process, as the word says. And in the first step, quite conventionally, the government issues debt. It issues bonds and bills and so on. And these are absorbed in the first step by that, depending on the country, by a syndicate of banks, by gilded banks, and it's a privileged groups of banks that underwrite that government debt in the first place and then sell it on to other investors and shadow banks and so on. And then early on, the central bank starts to buy up on the open market a certain part of the government debt issued before. The second step is the central banks buying up part of that government debt. That's the Paso Doble, okay? And this can, if all participants agree or are act in concert, that can be done in a way kind forever. No, because it can be rolled over, and if not rolled over, it can be, you can resort to that zero coupon perpetual console technique. It has been done before, and I would say, for pragmatic reasons, we should do so. I actually would say, yes, do so, continue to do so, and stop trying to repay public debt. Because public debt, for the most part, that comes from money it comes from monetary credit, be that from the banking sector or from the central bank itself, issuing large amounts of central bank reserves today or digital tokens in 5 to 10 years future. And that's monetary credit. And if you start to pay back monetary credit, you are reducing purchasing power, the macroeconomic purchasing power, which is very, very damaging. It has a similar effects to deflation. And for example, the United States, for example, to my knowledge, have not redeemed in absolute terms government debt since 1835, I think. So in absolute numbers, the US debt has never been reduced in absolute numbers. It was temporarily reduced relatively as a proportion, but not in absolute numbers. And that's important, not to reduce the monetary credit that exists, because that would create that contractive reactions. And yeah, that's why I'm actually in favor of what you say, because in my opinion, the introduction, I take it for granted that we will have central bank digital currency. It might also be a US Treasury digital currency, why not? If the Congress decided so, why not? But I guess it will be Federal Reserve digital currency. And that will be introduced not as, it will be introduced in parallel, in cooperation, even so in competition, but it will be introduced in parallel with bank money that continues to exist. And so that digital currency does not intend to put an end to bank money. But I think it intends to regain more control over the monetary system. Not full control, but more control than today, because today the monetary quantity lever for transmission of monetary policy impulses to the wider economy has become very short, basically, because the operationally necessitated reserves banks need to create money. That base of reserves has become relatively small, and that's why the transmission lever has become small. And central banks need to extend. They need to have more or a longer transmission lever again to regain more control over banks or money creation by the banking sector, and also think of, we have nowadays, we think in terms of a two-tier system, money system, central banking and banking, but today we have actually a three-tier money system, because we have new money surrogates, money market funds, e-money, and for example, stable coins. And we have also base money competitors like uncovered bitcoins or uncovered complementary currencies. So that has become a very complex a system in risk of becoming ungovernable, so to say. And I think so the introduction of digital currency, partly it is for technical efficiency, but partly it is for regaining a higher degree of control. But it's not intended putting an end to bank money. And so this is not a reform, this is not a sovereign money reform in our sense, but it is a halfway house from the present system to a more or less reformed system. It's a halfway house. It will not be full monetary reform in the sense of the Need Act.
Thank you, Bill. Just for the sake of time, I think we only have about 15 at the most minutes left for questions. We should move on. So I'll go in the order if your question, so go ahead, Joe. And somehow I'm not able to spotlight people. I'm not sure why now, but go ahead, Joe Polito. If you still have a question, otherwise we'll move on to Bruce Wall. There's Joe. Okay.
I have a question. Thanks again for today and all the work you've done on sovereign money. I've been attending a number of conferences by academics. One is called CBER, and they go from computer scientists to economists. I've also attended the hearings at the for the House and Senate on CBDCs. And there seems to be an attractive story developing from our point of view. Professor Kumhof said the same thing, that the threat of digital currencies is perhaps going to advance CBDCs more quickly. The academics are quite happy about the improving technology in the payment systems that's resulting, and they like the idea that the bank will face competition in the payment systems. They feel it'll be much less expensive and much more efficient in processing payments. So they don't want both things stopped completely. On the other hand, the politicians in the hearings have said they like the idea of the entrepreneurial part in improving payment systems and so forth. But it seems like some kind of crypto blockchain process is going to be permitted and regulated. But the consensus also seems to be that these new payment systems would be a threat to monetary sovereignty, to political sovereignty, and consequently, they're very much in favor of CBDCs, it appears, which they see as a form of digital cash, which isn't quite as anonymous as real cash, but it certainly could be equal to the kind of protections we have with bank money. So my question to you is, do you see this emergence of crypto, blockchain, et cetera, currencies as something that will enable us to move faster into CBDCs and sovereign money? Thank you.
Well, my answer is yes. Yes, I think so. To my knowledge, it need not necessarily be some sort of blockchain. It might be a kind of permissioned blockchain, not entirely decentralized, but multi-central, permissioned in a way because the central bank or the US Treasury, they certainly need to have some control. And as far as I know, there are also different types of cryptographic technologies that can do without a blockchain. And I think all of this is welcome, particularly if it's actually more efficient, if it accelerates money circulation, if it's less expensive, and so on. If it really allows today's non-banked to participate, because across the world, in many countries, people in developing countries, half of them, depending on the country, they don't have bank accounts, but they have handhelds, they have mobile phones, and that would permit them to participate in using crypto tokens. And so I think all of that is quite welcome. Crypto tokens also promise to be programmable. They can be used to connecting them to smart contracts and very interesting things. And I really think that is the future. And of course, it's very important that this is not entirely left to private commercial interests, but that also the public bodies in money, the treasuries and the central banks, they need to be part of it. And as I think they need to be a leading part of that. I think the uncovered cryptocurrencies as we know them today, I guess they do not really have a future as a means of payment, not as a universal means of payment. They will have, or they might have a future as a special purpose instrument for special interest groups. That, yes, why not, but not as a general means of payment. I see more chances for so-called stable coins. And these stable coins are called that way because not because they are of stable value, but because they have a stable link to a national currency. Normally, in most cases, to the US dollar. And I think as long as you have a peg to a national currency, particularly the US dollar, the US authorities do not need to fear a loss of control. They had to fear loss of control from the type of stable currency that was planned initiated by Facebook. So the so-called Libra, it was that would have been a stable coin called Libra, and that would have been based on a supranational basket of reserve currencies. And that is really a threat to national monetary sovereignty, because in large numbers, you see big tech companies, they have hundreds of millions of customers. If only say 10 or 15% of them would start to use stablecoins issued by these organizations, by a syndicate very large high-tech and web corporations, that would really be strong competition and a threat to currency sovereignty, to the competition to the national units of currency. But then there was strong opposition to that, rightly so, as I think. And then they had the idea of creating, they rebranded the entire project. They called it DM, and that would have been based on the US dollar only. And that now found the agreement of the American politics and of the Federal Reserve and of the US Treasury, because in actual fact, that would be something that contributes to the dominant role of the US dollar in the international currency system. But for different reasons, many participants of the project, they started to quit the project and they have given up on it. And the reason was that it was foreseeable that what the authorities would demand in terms of coverage of that for that stable coins, that apparently was no longer very promising in commercial terms, because in order to be profitable, the issuance of such private currencies or stable coins, much like bank money, either you have only a fractional coverage, because if you have full coverage, where does the money come from? You need to have fractional coverage, or you have full coverage, but need to be able to invest a certain part of that coverage into financial market business, into so-called cash equivalents and so on, so that this generates then profits. But if the supervisory bodies say, we expect you to have full coverage, something close to like money market funds, full coverage clear to 9900%, then this is not really entirely, it is not very lucrative. And that's why they have stopped the system. But I'm sure the development has just begun. That will be the future. I'm convinced of that. And that's why it is very, very important to have sovereign money in the form of digital tokens.
Thank you for that, those details. Go ahead, Bruce. You are spotlighted. You have a question?
I want to go back to Margaret's second question, which is, I actually have three other questions, but I won't ask them today. But I would like to ask if it's possible to send them along to Professor Huber, because this has been a marvelous opportunity to put questions directly to him.
Oh, sure, yes.
Okay, thank you.
Yeah.
But the first question, going back to Margaret's, she said, where does the money go from assuming the central register, the central bank currency register, how is the money that goes from that central register issued? You mentioned, I think, two channels,
yes.
But and then how is that accounted for?
Well,
and if so, then it seems to me that however it's issued, there is some sense of some form of distribution, first use distribution. That's part of the reason for the question.
Yeah, right. First use is the key word here, yes.
Yeah.
And well, very simply, there are two channels of issuance. One is letting part of, or even the major part of that money to the public purse, debt-free, which can be done from that currency registry. It cannot be done from a normal commercial balance sheet. That's one of the advantages of having such a body.
The public purse means what? The public purse means what?
The public purse, well, it's the public household, the public budget.
Okay.
Yeah, it goes to the treasury, and then it will become part of public expenditure, And that's the way how it starts to circulate, by way of public expenditure. And it's up to the government to decide upon the purposes on which the money is going to be spent. That's not the business of the currency register. And in my opinion, it isn't the business of a central bank. The central bank should not intervene too much in capital and credit markets. Not too much. In macroeconomically, in basic questions, yes, but not too much. And so it should be up to the government to decide how to use that seigniorage. And the other channel is making that money available for central bank banking business. And so central bank bodies, the Open Market Committee or whatever committee there, they will decide. And that money is very likely to be lent, of course, to financial institutions. And possibly there might be some macroeconomic conditioning, I would say, regarding the difference between financing economic activities that contribute to the real economy, trying to avoid first uses for mere non-GDP financial transactions. That might be one criterion. Well, it's so central banking itself can continue such as it is, basically. But the difference would be that the hope is, in the longer term, that central bank digital currency, or maybe even central bank money on account, why not? We should not not try to foresee things we can't foresee. But the important thing is that central bank money need to regain a position comparable to that of cash 150 years ago. No, 150 years ago, the larger part of the money supply, that was banknotes, private banknotes to a certain extent, but the majority of it was central bank notes at the time. In the United States, of course, treasury notes, the greenbacks, started by Lincoln, but also during a certain time, the graybacks from the Confederate States. And future digital currency should regain a comparable position so that the dominant type of money would no longer be bank money. And that's actually what I think. So there is a certain I think it's likely that the spread of central bank digital currency, or say sovereign digital currency, whoever issued it, and the spread of particularly stable coins, that is a competition to bank money, and that promises to be, sovereign money promises to be more safe, and it has the same advantages of efficiency and so on. And bank book money cannot compete with digital currency. So that is what I can see at this point in time. Mm-hmm. Maybe to a certain degree, it's what I hope for. I don't know. We will see. Yeah. And
thank you.
Yeah.
Thank you very much.
Yeah.
Thank you. So as long as it's quick, Mike Holden, you're going to get the last question. And I think we maybe have to do a doodle poll for scheduling our next meeting. But go ahead, Mike, if you want to, Mike can add a. Thank you.
Sure,
Bruce.
yes, thank you. I appreciate it. First of all, Professor Huber, I'd like to thank you for all the excellent work. I very much appreciate the work that you've done on sovereign money and the perspective and clarity that you bring. I just wanted to say a few things about the issuance or distribution of sovereign money. Thinking of sovereign money as an asset, I think, is critical because it eliminates this structural debt burden that is imposed on society through the government when we have money created as a debt or through a debt burden. So I think that's a very important point. But on the distribution side, if we have the government distributing money directly for public purpose projects, first of all, there's no debt involved with any of that activity. If there's no burden to repay, there's no debt. And you can think of the money as being sort of like a representation of a social asset. And so I view that as a very positive kind of monetary framework. And that's why I think the accounting mechanism here is critical, because it seems as if the accounting mechanism leads to this structural debt burden. And so I wanted to get your opinion here on having money defined as a liability and how it can create a structural debt burden, if you think that that would be an accurate characterization.
I'm afraid I haven't got the first point. Why asset money from the beginning? Why that would be a structural debt burden on? I didn't get that. No.
There would be the liability. Money defined as a liability, creating the structural debt burden.
You see, an idea behind is, I think sovereign money, particularly sovereign money, should be safe. It should be a safe asset. And if you create money by way of credit and debt as a liability, that money is not an independent being, but it's part of the financial economy. And if the financial economy is in crisis, the money is threatened. That's the situation we have today. If banks, including central banks, run the risk of becoming insolvent, if they're going bankrupt, so then the money will disappear, and that's a catastrophe. But if you have money as an asset in its own right, the money as such not being part of credit and debt, and an instrument for credit and debt, but the money itself not being credit and debt. So that is a kind of it shields the money against problems in the financial sector. And it's important that the financial sector be built on a safe and stable monetary base. That's one of the basic ideas behind. While as long as we have credit money or liability or debt money, the money is part of the financial economy, is part of the dynamics of the financial economy, is part of recurrent crises in the financial economy, and so on. And that's why I'm in favor of that. And if you could repeat a few words that I might grasp what you mean. It's a structural debt burden, and it's, so to say, something dysfunctional, if I understand rightly.
Yes. So with money created as a debt or as a liability, that means that the government has to create notes of indebtedness. Those notes of indebtedness are then sold to, well, in the case of the United States, the primary dealers at interest, right? So then the government then owes interest to the primary dealers, or if the primary dealers then sell those notes of indebtedness, whoever buys those then is owed a certain interest, right? So then the government then has the structural debt burden in the money creation process to fund its operations. It is required to go into debt and pay interest on those debts to private agencies. And so that's what I'm referring to as the structural debt burden.
Yeah, that's the way it is. We actually would want to overcome that situation. And what is the problem if we were able to overcome that situation? I don't know. Where is the problem you see? I still haven't got it. I'm sorry.
Well, I think you answered my question. I just wanted to make sure that you think that would be an accurate characterization of the situation.
Yeah, what you have explained, I understand that as a problem. And if you mean it as a problem, I agree with that. Well,
it's the problem we're trying to solve.
Yeah.
Right. It's very late for Joseph Huber, so I don't want to go over time. And I think we will do our scheduling for our next session on a poll. But towards that next section, I have one question for you, Dr. Huber, and that is if you could shed any light on who Thomas Meyer is, and in particular, what your assessment of his work or your guidance for us as we read the piece that he co-authored by Schnabel, How to Escape the Debt Trap, which came to my attention through Mona Tativa's website through my spouse. So could you comment on who he is and what you think of his work and guidance for us as we look at it?
You mean right now?
Yeah, in this moment.
Right. Yes,
to
of
help
course.
people decide if they want to read it.
Yeah, sure. Well, you see, we know Thomas Meyer very well. And as you may know, he is the former chief economist of Deutsche Bank that 10, 20, 30 decades ago was one of the largest banks we had. Also at that time among the largest banks worldwide. At that time he was chief economist of Deutsche Bank. And so he knows the business very well. And he's actually on our expert board of our monetary reform initiative. Mm-hmm. He started as an Austrian economist and as a neo-Austrian economist. So he actually opposed to sovereign money, actually opposed to government or state money. But over time, he came ever closer to us. And then there were a couple of years where, again, he distanced himself a little bit from us. Then he came back again. And he wrote a book on monetary reform that was very much in line with, he was among the first to develop that equity approach. From that, also included in the paper by Kumov and Omarova and co-authors. Thomas Meyer was among those who started to develop that equity approach. But I think at the time, about 8, 9, 10 years ago, he too didn't get the accounting thing quite right, but it was a beginning. And so we have, how should I say, very lively discussions. We continue to have very lively discussions because we very often disagree, but we have enough common ground to, So I think that paper, that historical review of possibilities to reduce the public debt, my first reaction to that a couple of months or when they published that, my first reaction was, we shouldn't think about reducing public debt because as Bill Clancy put forward that question, that with the passo doble, if we try to reduce public debt, we reduce monetary credit. And that's something Thomas Meyer and Ms. Schnabel, they didn't take into account. They didn't consider. And I think it's, in the current situation, it's very difficult, it's very problematic to reduce public debt. That in one of those ways they have considered, because this will macroeconomically reduce the available purchasing power, that will reduce the available amount of money. Even so much of that is still is in non-GDP finance, nevertheless. So we really have the experience that in all countries where the governments try to reduce public debt, we have a situation of stagnation. You know, important investments are not being done. And so we have a decay in public infrastructure. We have undermanning in public services and so on, you see, and that's very problematic. So my reaction to him was, we should not think about, in the current situation, we should not think about how to reduce public debt, in that way reducing monetary credit. So, so that's why I am in favor of a way of neutralizing public debt, doing that zero coupon perpetual console thing. Something, by the way, we discussed with Thomas Meyer, and he is not entirely opposed to it. He doesn't like it, but he's not entirely opposed to it, like me, for pragmatic reasons, because that's something we actually can do right now.
Thank you. That was helpful background and oversight. And I think with that, we should call this over. But again, really nice to see you and have a little bit more time for discussion. So thank you for staying up late. And I hope tomorrow is just as sunny and you can get out. And hopefully thank you for serving as one of our advisors, and we will be in touch, and we will tap you again as we need be, but vice versa, please keep us in the loop of critical things that we need to understand and act upon. So thank you for playing that role. And
yes, and thank you for inviting me, and thank you for this very, very interesting discussion we've had the last 2 hours. So thank you.
Thank you.
Have a nice day still.
yeah, thank you everybody for being here.
Okay.
I'll close up shop last, so if anyone needs to talk, they can.
Okay. Bye-bye to everybody.
Bye, Joseph.
Okay.
Bye.